Okay, folks. Thank you for getting your numbers in. I think almost everybody did. And if you haven't, get them in by 5 o'clock. So that way you're not losing the 5 points. It's a pity if you do your project and lose the 5 points because you didn't enter the numbers. But I got, I think, 318, 317 out of the 325. So pretty much all the numbers. So what you're going to see in this in the session actually is a combination of two things. One is I'm going to use your numbers to take you back on a journey through this class, and you're going to see we didn't cover that much. Felt like we did do a lot. And along the way, I also want to talk about one topic we didn't quite get to in our last class, which is about changing value and how it plays out in the value of control, which has lots of implications in investing. So let's start the game. And when I started this class, I said, nothing will stay still. And I think I've kind of delivered on that promise. You can see now why the Chinese say, may you live in interesting times as a curse, because we do live in interesting times. Sometimes you wish things were a little more boring. But let's start the process by looking at the 3 ways we said we could put a number on an asset. The first is intrinsic valuation. You can dress it up as much as you want. But what are you trying to do? You're trying to guess what the growth, the cash flows are for a company. You attach a discount rate that you hope and pray will capture the risk in that investment. You get a present value. That's it, right? Then there's pricing. The essence of pricing is you attach a number to something based on what other people are paying for similar things. And the third, and this is a special subset of companies, where if something happens, a company could be worth a lot, a contingency. The young biotech company, that's a drug working its way through the FDA pipeline. With an oil company, it might be undeveloped oil reserves going from non-viable to viable because the oil price goes up. Ultimately, everything we do has to fall into one of those 3 buckets. And if you go back to the very basics of intrinsic valuation, it's one equation. Right? That's it. That's all this class has been about, is one equation. Everything we've done in this class is about getting better ways of estimating expected cash flows and trying to think of better ways to adjust the discount rate for risk. Embedded there are 4 inputs. The first is, what are the cash flows you're getting from existing assets, which is what you get from looking at the current financial statements of the company. That's the easy part of the valuation, because you take the financials. And if you're doing financial modeling, that's basically it, right? You take the past, you just extrapolate it. But in a true valuation, the real place you get challenged on is, what is the value of growth? And the value of growth can be positive, negative, or neutral, depending on what value? Whether you earn more than your cost of capital or less than your cost of capital. And if you remember the statistics, creating value from growth is really, really, really difficult to do. Manan, what was the statistic we pointed to? that pointed out why the creating value from growth is so difficult to do. And in fact, we also looked at the table across the world of what percentage of companies earn more than their cost of capital, right? It was just a flash and it went by. 70% of companies globally have a tough time earning their cost of capital. So when you look at your company, say, my company will create value from growth, you're already looking at an exceptional company. The only place in a discounted cash flow valuation where risk enters is through the discount rate. Your expected cash flows are expected cash flows. They're not risk adjusted, they're just expected. You bring in the risk through a discount rate, through a risk premium, either as an equity risk premium in your cost of equity or as a default spread in your cost of debt, and you get a cost of capital. And you have this issue in valuation, which is, at least in theory, a publicly traded company can keep going and going and going, and you want to stop somewhere, 5 years, 10 years down. The way we put closure is with the terminal value. The most common way, at least in every textbook of doing that is, how do we estimate terminal value? We assume that growth will continue in perpetuity, and that's okay as long as you have a company with a long enough life. No company lasts forever. We know we're, but reserve the option of, in your company, saying, in my company, I'm going to not use the perpetual growth model because the life is short, and assuming forever is not, you can use a growing annuity, or if it's a private business, even a liquidation value. That's closure. And I boil down even simpler if you look at the FCFF Ginzu model by looking at 4 basic inputs. I'm now going to argue that ultimately what you see in cash flows flows through one or more of these inputs. The first is revenue growth, capturing how much your company can grow, which will be determined by both the size of your company and the size of the market. If you're a big company in a mature market, Costco, Walmart, not much room for you to grow, not because you're not trying, but because there's no headroom. If you're a smaller company in a growing market, Palantir, you could potentially have really high growth. Doesn't mean you're guaranteed that, but it's the potential for growth. So that's a growth part. But growth by itself doesn't create value. You got to make money. So the second question I ask you is, how profitable is your business? What kind of margins can you expect to have? And there again, economics kind of limit you. If your unit economics are such that it costs you 80% of every dollar of revenues, it's going to be tough for you to have double-digit margins. But if you're a company like a software company where your unit economics are the next unit you sell, almost everything you make is pure profit, your margins can be much higher. And the way we tie up and hold people accountable, say, if you want high growth, tell me what you will need to reinvest. And the sales to capital ratio operates as a lever of that. Revenue growth, margin, sales to capital give you your cash flows. And I give you 2 places to put risk in. One is through the cost of capital. The other is through this failure risk input. Why do I have it in there? Because failure risk is really difficult to bring into a discount rate. It's discrete risk. So with your company, I stop and ask, is there a chance your company will not make it? It's a small money-losing company. If it's a distressed company, that risk is obviously not going to be 0%. Those 5 inputs basically drive your entire valuation. So I'm going to give you a triangle that I use whenever I look at your valuations that I find useful in asking, is this valuation internally consistent? There are 3 sides of the triangle. There's growth, there's reinvestment, and there's risk. In general, you have trade-offs. To have higher growth, you often have to settle for more reinvestment, lower cash flows. Often with higher growth, you also have higher risk. Are there special companies? Yes. In special companies, here's the combination you'd see. You'd see high growth, high margins, and low reinvestment. Those companies exist. They become the Mag 7 and the trillion-dollar companies because they've got the best of all worlds. So that's the lead in intrinsic valuation. Let's see what you found. Remember, I didn't restrict you from picking the same company? Quite a few of you picked the same company. 8 of you picked Boeing. Right? Why Boeing? Because it's at that interesting cusp, right? It could either go downhill and it could be done, or it could come back. So for whatever reason, a lot of fascination with Boeing. Second was Intel, another company that's on a cusp. Then DraftKings, probably because you lost a lot of money in the basketball last week, and I don't know why that showed up. No? And then Duolingo. That should be O, not A. Okay? Snowflake, and then there were 6 companies where at least 3 people valued the same company, and at least 4 companies where at least 4 people valued the same company. And early on, somebody said, is it okay for me to value? In fact, no, there are some of these companies I valued as part of the valuation of the week and didn't stop you from using those either. You know why I don't mind people valuing the same company? There's DraftKings. 5 of you value the company. At least you gave me the same price, which tells me that you took my instructions too hard and used the Friday price. Some of you used last, so that was it. So you're at least the same price. Valuations were different. Why? Because you had to make choices, right? Growth and margins and reinvestment. Of course, you're going to get different answers. Multiples, all there's 1P, a couple of 4 EV multiples, different pricing. There were 3 buys, 1 sell, and 1 hold. Clearly, there's divergence. Am I surprised? No, it's a young company. There's a lot in front of it. You could come up with any of these basically. So this notion that we all do DCF, we're all going to get to the same answer is absurd, because think of all the choices you had to make to get there. Here's what you found. So basically what I did was I took your DCF value. Before I do any of this, these are the numbers you gave me. So if you have strange looking numbers in there, it's not my fault. This is numbers. So I'm basically taking, you know how there's disclaimers in the investment banking emails, like it goes an entire page. I am not responsible for any of the numbers in there because these are your numbers. You might have been drunk or you might have been tired at 12:30 at night. God only knows what you were entering. So some of these numbers I looked and saying, that can't be right, but I let your number kind of ride, right? So if you look at your DCF value, here's what I did. I compared your DCF value to the price. On average, what you found, I mean, I was tired too. I have 2 eyes in median, so there's only 1 eye, right? Your median company, so that this is the price as a percent of DCF. So your median company was overvalued by about 28%. About 35% of your companies were undervalued on a DCF basis, 65% overvalued. Are you surprised? You think that number is always going to be less than 50%, or? It varies over time. Right now, in this semester, in this class, far more companies came out as overvalued than undervalued. Why? It might be a function of the fact that the market's been up strongly over the last 5, 6, 7 years, and you're capturing the fact that the price has gone up too much. Part of it is, what's the news we've been reading all semester? The world is ending, the world is ending. How can you be immune from that? They're all percolating into your choices. So here were your most undervalued company. Yeah, go ahead, William.
If you happen to know if that matches the analysts' report.
How many buys for every sell are there with analysts? Typically 9-1. This spring it might be 8-1. That's it. It never goes to 1-1, right? So it never happens that way. So you're not getting the same degree of, in the analysts. It's lagged. It's not necessarily going to show up. So these were your most undervalued companies. As as you look at that list, I have to tell you something I've done for the last 30 years. Every time I've taught this class and I come up with a list of undervalued companies, I buy one of these companies based on your recommendation. I hold it in a separate portfolio. I'll show you what that portfolio looks like. But I do it only on one condition. You know what the condition is? You actually put real money behind your recommendation. No, if I had the money, I'd invest. No. That's not going to fly for me. If you have one of your companies is on this list and you're putting real money, let me know and I'll come along for the ride. And I promise you, I won't harass you 3 years from now if the stock goes down 50% saying, I lost money. I go in with open eyes. So here are the most undervalued companies. Azul, who did it? Anybody who did Azul? It's a Brazilian company. I've heard of it. I don't know much about it. Most undervalued. Price was only 31% of value. So basically the value is almost 3 times higher than the price. And you've got Publix, Joy. A lot of companies here that you can see are non-US companies in the mix that I don't know much about. But clearly you have a story, you have a valuation, you have a value much higher than the price. These were your most undervalued companies. In fact, Target makes the list, which is surprising because a lot of people are down on Target. Basically, it shows up as one of the most undervalued companies. So if you're on that list and you're actually investing in the company, let me know and I'll make my choices, which is why? Because I've been tracking these undervaluations for a long time. Okay? These are the most overvalued companies. Who's doing Nissan? I mean, that looks like it's a math, maybe it's an input number. Yeah. Either the price per share is off or something is clearly not quite syncing there. So I don't know whether you went from yen to dollars and back again. So I would love to see your actual report before I make a judgment, but something clearly seems to be off there. No, no. But keep going down. Those are your most overvalued stocks on the list. 480. So basically what you did, maybe there was a switch in currencies along the way. That's not, that you can't do that, right? You got to have all in the same currency. Go back and fix it. If that's your company, it's okay. So basically there are, take it for what it's worth. This on a valuation basis, these are the most overvalued stocks. As I said, I take no responsibility. These are the numbers you fed me. Yes. I'm sorry, I can't hear you.
Like almost times after, right? So maybe like it's just noise from the mic.
It could be. It could be that it's so over levered that So I'll concede that, but I would just first check and make sure it's not a currency mismatch that's driving it, right? So I've been tracking these valuations now for a while, and this is so you need to give some time, right? When you find something under or overvalued and intrinsic value base, it's not fair to check you 6 months later. So I wait 5 years and then I track what these buy and sell recommendations have done. And I'll give you the good news. On average, there seems to be information in your buy and sell recommendations. What does that mean? These are on average what buy and sell recommendations did for, I've listed out 6 semesters here just to see. The buy recommendations, the blue, the sell is in whatever this ugly color is, and the S&P 500 is right in the middle. So on average, your buy recommendations do better than the index, your sell recommendations do worse. But before you get too carried away, there's a lot of noise in these recommendations. What does that mean? 100% of the buy recommendations don't go up and 100% of the sell recommendations don't go down. In fact, about 60% of all buy recommendations beat the market, which means what? 40% are going in the wrong direction. About 45% of sell recommendations beat the market as well, which means so there's noise on both sides, which is to be expected, right? You make your best estimate, you're going to be wrong. Okay? The buy recommendations that have had the most heft have been on buy recommendations on small companies and emerging market companies. So that's why the Azul, for instance, I would look carefully at it. It's a Brazilian company. Most of us are not familiar with it. Maybe you're more likely to find mistakes when you look away from the high profile, it's tough to find massively misvalued companies. You're looking at the Mag 7. Third, and this is a characteristic of investing in general. If you look at the returns that these choices have made over long times, they've usually come from one big company, one big winner carrying the portfolio. 1999, for instance, one of the stocks that came out as a buy was Apple. And if you bought Apple in 1999, you bought it for like $2 per share because people thought it was essentially going to go under. And that plays out in choice after choice. It's one or two big winners carry the portfolio. And finally, companies where both the DCF and the pricing push in the same direction do much better than when they push in different directions. I know we often end up in a camp. I believe in intrinsic value. I believe in pricing. And my pushback is, why do you have to pick a camp? Why can't, I believe in intrinsic valuation, but I do think there is value to knowing what the pricing should be for the company. So even though your recommendation might have been based just on the DCF value, your pricing is somewhere in the background affecting your decision as well. So that's the DCF value. I'm going to take a little tangent now and talk a little bit about the value of control. Last session, we talked about value enhancement, right? We talked about increasing cash flows from existing assets by cutting costs, being more efficient, paying less in taxes. We talked about increasing value from growth, which can take the form of either growing more if you're in a good business or growing less if you're in a bad business. We talked about competitive advantages. things you can do to extend your growth period. We didn't get a chance to talk about the cost of capital, but in a sense, there are ways in which you might be able to change the cost of capital for your company. Let's look at the ways in which you might be able to lower the cost of capital. One is changing the mix of debt and equity, right? Will more debt lower your cost of capital? For some firms, it will. Will less debt lower your cost of capital if you're an over-levered firm? So thinking about what drives your cost of capital across the capital structure, maybe there's a better mix. Here's the second way you can lower your cost of capital. If you mismatched your debt to your assets, using short-term debt to fund long-term assets, dollar debt to fund euro assets, you're creating default risk you don't have to. Getting rid of that mismatch reduces default risk, reduces your cost of capital. There are also two other ways that come about when you think about what drives betas. We talked about discretionary versus non-discretionary products, how they play out in higher betas. If your product or service is discretionary, you make it less discretionary, you in effect lowered your beta, lowered your cost of capital. And the other was fixed costs. We have a lot of fixed costs. I said your beta goes up. So reducing your fixed costs in your total cost structure also. So ultimately, four ways to create value: increase cash flows from existing assets, increase value from growth, reduce your cost of capital, or push out that stable growth period by building up a competitive advantages. Everything in restructuring falls into those four buckets. You've done a valuation for your company. For most of you, it's a status quo value. You know what I mean by that? You've run the company, you value the company with the existing management running the company. So now Unvalued Ubisoft is based on existing management running the company, and that's built into your premises. And I would wager every one of you, something's been built in reflecting the existing management. What if I gave you a chance to revalue the company with somebody else running the company? Because sometimes when you look at your company, say, if I ran the company, I would do things differently. I know it takes a bit of an ego to be able to do that when you've never run a company, but some companies you look at say, I would do things differently. What if I let you play that out? So you're going to value a company a second time with somebody else, maybe you or somebody that you think can run the company better. Would you get a different value? Yeah. In fact, the only companies where you're not going to get a different value are companies that are already perfectly managed and perfectly run. So you might look at NVIDIA and say, what am I going to be able to do that Jensen Huang hasn't thought about yet? But if you have a company that's badly managed and badly run, and you can see already with Boeing and Intel, that's going to be a big issue, right? Because clearly these companies are in trouble, but they still have advantages that if you had the right management in place could give you a very different value. That's going to become what I use to talk about the expected value of control. So you have two values for every company. So you can take each of your companies. Don't worry, this is not an added thing you need to do on your project, but you could take the companies you've already valued and revalue them with a different debt ratio, different growth policy, different reinvestment, and come up with a different value. That difference is going to what you can get by changing management. But to do that, what do you have to do? You have to change the management of the company. So the factor that goes in the expected value of control is the probability that you can pull that off. Let's see why that might vary across companies. If you're in a market where hostile acquisitions are banned, much of Europe, for much of the last century, even going into this one, companies could not do hostile acquisitions. It was not allowed by the law. When you ban hostile acquisitions, you reduce the chance of management changing. If you have companies with different voting rights, much of Latin America, until very recently, every company had two classes of shares, one with voting rights, one without. That process is spread into the US, right? You look at Facebook, you look at Google, you have companies with different voting rights, you've reduced the chance of changing the management of the company. If you have to change the management of the company, you need to have access to capital. There's a reason that you have the most activist investors in the US because you can have access to capital. If Bill Ackman doesn't like the way a company's run, he can raise $5 billion and try to change the way the company's run. That's not always feasible in some markets. And finally, it's easier to change the management of a company if it's a small company than a large one. You might not like the way Satya Nadella is running Microsoft, but what are you going to do about it? It's $3 trillion. That's a lot of money to be able to raise. Large companies are going to be much more. So you can already see if you look at your company, in some of your companies, you can look at your company and say, there's zero chance of me changing the management of the company. Why? It's a family group company. The family controls the company. I can't change it. And some of your companies, the probability of change is going to be much greater. That product the probability of change times the expected change you can get by running the company differently, is the value of control. So there are 4 places this will come up. But if you look at cross markets and across companies, here are the reasons the probability of management changing is going to vary across companies in time. First, it's going to depend on what kind of corporate governance rules you operate under. In much of the world, until the last 20 years, corporate governance worked against management change. It was very difficult. In the last 20 years, many emerging markets have tried to create corporate governance rules that allow for change. They don't do it because of the goodness of their hearts. They want to attract foreign institutional investors. And the only way you can do that is by making the rules fairer for people to change management. You need activist investors. What do activist investors do? They make pests of themselves. Nice people don't become activist investors. Because you need to get in management's face and you need to tell them, you're doing a terrible job, I want you to change. No. And thirdly, when you have a hostile acquisition, it's not just the company that's targeted that gets a message, everybody else gets that message too, saying if you don't do what's right for your shareholders, eventually somebody's going to come for you. Even in the US, the chances, the power of shareholders to change management ebbs and flows. There are periods where it's great, periods where it falls off, depending on the market and the activists investing at that time in the market. So ready? There are 4 places I want to bring in this expected value of control. I'm going to argue that when you look at the market price for a publicly traded firm, a Boeing or an Intel, that market price already reflects some expected value of control. Do you see why? As an investor, you're pricing Boeing, what are you doing? You're taking Boeing and saying, what if it's run the way it is? What if somebody else ran it or ran it differently? What you see as a market price reflects an expectation of control changing. So I'm going to start with that. Second, I'm going to go focus specifically on hostile acquisitions, where we talked about the value of control as being what you can do to a target firm as the acquiring firm. They have complete change, and you can basically claim that difference. You can talk about how much is that value and how much should I pay for it. The third scenario I want to talk about is companies with voting and non-voting shares. It used to be in the US that there were very few companies with 2 classes of shares because for the longest time to be listed on the New York Stock Exchange, you had to have only 1 class of shares. NASDAQ basically changed that with Google coming in saying, I don't care if I'm listed in the NYSE. We're going to have 2 classes of shares. Now, if you look at large companies, many of them have 2 classes of shares. Now, if you're voting and non-voting shares, Tyler, which one should trade for more? The voting shares, because you get. But the question is how much? Bankers usually put a rule of thumb. I'm going to give you a much better way, hopefully, of estimating how much voting shares should trade relative to non-voting shares. And finally, we talked about private company valuation. Talked about all the issues, total beta, liquidity discounts. But let's say you're thinking about buying a private company, and I offer you 49% of that private company. I'm going to argue that what you pay for 49% of a private company will be a lot less than if I offer you 51% of that same private company. It's only a 2% difference, right? What's the advantage of having 51%? You can change the way the companies run. We'll talk about, that's called a minority discount in private company valuation. We'll talk about how to use that structure we've set up for expected value of control to quantify that difference. So let's start with every publicly traded stock. I'm going to argue that every publicly traded stock in the market, investors are already juggling 2 numbers, the status quo number and the number that they think this company will have as a value if it's run differently. It's true for Boeing, it's true for Intel, it's true for Starbucks, Walgreens, you take any of those companies. Saying, how is the market assessing that probability? Subjectively, like it does everything else. But if that is the case, let's look at the implication. The market price of every company reflects the status quo value and a value with change. If you're in a market where there is 0 chance of corporate control changing, you know what's going to happen, right? The price for every company is going to drop to the status quo value. Good companies, bad companies are all going to have a status quo value. Let's say in this market, I introduce a new corporate governance set of rules that allows for management change. You know which companies are going to see the prices jump up the most? Badly run or well-run companies? In a market where everything was priced at status quo value. Sophia?
Change management
badly managed companies, you're going to see the price jump up more because people say there is a chance. So you see often emerging markets talk about corporate governance changes. If you think they're serious about this, you know what you should do, right? Load up in every badly run company in that market, a portfolio of badly run companies, and sit and pray that they actually mean what they say, that corporate governance change is coming. That's the first. No. Second, hostile acquisitions. Now, one of the companies I valued in 2003 was a company called Blockbuster. Have any of you been in a Blockbuster video store? There was a time when they were ubiquitous, they were everywhere. You know how it was created as a company, right? It was created by rolling up privately owned video rental stores across the country. You talked about rolling up private businesses? Incredibly successful in the 1990s because everybody wanted to watch tapes in their nice VCRs. Took off. And then two things happened that kind of put Blockbuster's business model at risk. What is the first? Netflix. Do you know how Netflix got started, right? When you first became a member of Netflix, you basically you'd rent CDs or tapes. Actually, the people rented tapes as well. Remember, they actually had tape machines. They would mail you the tapes and then you'd mail it back, physical mail. So one thing that started happening was people started using Netflix because it was cheaper. Because Blockbuster was like $4.99 a night, and then you forgot to return it. Before you knew it, you owned the tape because they added so much as late fee. The other thing that happened was Redbox and Walmart started renting out videos in those. I don't know whether they still have these vending machines where you could go in and you could get the videos that everybody was watching for $1 a piece. So you got squeezed in both ends and people stopped coming into Blockbuster. If you're running a business where people are they're not coming into your stores to rent anymore, what's a logical thing to do? Stop opening stores, right? But Blockbuster seemed to have missed that message. They kept opening another 20 stores every year because that's what they'd always done. So by the time you get to 2003, Blockbuster was a disaster waiting to happen. It was targeted by activist investors saying you need to stop opening stores. You know, it's not even a question of shutting down stores, just stop opening stores. At that time, I actually did an optimal value. It was actually, you did two values. You got a status quo value of about $5 per share. They keep doing this insanity of opening stores, and I came up with a value of 12.5 if they just stopped opening stores. Basically, so send all those store people home, no more new stores. The stock was trading at about 9.5. Let's say you're targeting Blockbuster for a hostile acquisition. You got three numbers here, right? You got the $5 status quo value, you got the 12.5 optimal value, you got the stock price of 950. Why is the stock price in the middle? Because investors are already looking at the company saying there is a chance that change will come. You can actually back out a likelihood of change from that price. But let's say you're the acquirer. You got a $2.97 you can pay as a premium because $12.47 is the optimum value. The stock price is $9.50. If you did that, paid the entire $2.97 as a premium, what are you going to make as the acquiring company?
Zero.
You're going to make fair value, which basically is the net present value of zero. So already you can see you want to negotiate for that because you're going to do the dirty work of fixing the company. So in acquisitions, it's true you can value control, but as we talked about with synergy, you're going to try to negotiate for a piece of that control, maybe 10%, 15, 20. Anything's better than 0% or worse, paying too much. You're trying to get a share of that. So in hostile acquisitions, the value of control comes into play. Let's talk about voting and non-voting shares. Did anybody in the class do Embraer? And in my MBA class, somebody did it. You're familiar with Embraer, right? Never heard of Embraer? Next time you're in a short haul flight in the US, there are only two because those smaller aircraft, Boeing and Airbus don't make. They're made by Bombardier, they're made by Embraer. So Embraer is it's a Brazilian aerospace company that makes smaller passenger craft, 30 people, 40 people. These are the kind of planes where you get up and you say, please God, let me get to wherever I'm going because it kind of don't get me wrong, the safety is fine, but you're flying and now turbulence makes you feel like you're on a roller coaster and you eventually get where you're going. It's been around a while. It used to be a government-owned company at one point in time. About 30 years ago, it was privatized. What does that mean? The government-owned company was made public. The government retained a golden share. You know what a golden share is? Anybody? They have veto power, basically. So the government retains veto power. So it's a company that's publicly traded, but the government is a player in the game, a big player in the game. File that away because this is going to become part of the story. This was a valuation I did maybe 20 years ago, where I valued the company twice. I first did a traditional DCF value, revenue growth margins, reinvestment, saying the existing people run the company. It's worth about 12.5 billion reais. Then I revalued the company with changes made, an optimal debt ratio, a more sensible reinvestment policy, and I came up with 14.7 billion. So let's pause right there. $12.5 billion status quo value, 14.7 billion optimal value. The company had two classes of shares. So you guys are going to get the voting shares. There are 242.5 million voting shares. The rest of you, in this case, 747, are going to get non-voting shares. Same company, you get voting shares, you get non-voting shares. What's my task? It's to figure out how much more the voting shares should trade for relative to non-voting shares. So hang in here with me because I'm going to try. When you get a non-voting share, what are you getting? A share of the company, but you can't change the way the company's run, right? Which looks like you're stuck with the status quo value. You can't change it because you don't have a... So here's what I did to value the non-voting shares. I took the status quo value, 12.5 billion, divided by the total number of shares outstanding, voting and non-voting, and I came up with the value per share of 17.38 reais per share. So basically, if you're a non-voting shareholder, you're stuck with the status quo value. Let me finish that and I'll take it. As a voting shareholder, what is the power you have? You could, if you could vote, change the way the companies run. Is there a 100% chance of that? Not likely, because the government is a big player and they might get in the way. So attached a 20% chance that you could actually pull off this change. We'll see what happens if I make the 20% into a higher or a lower number. Why is it so low? Because it's a government-controlled company with a golden share. If that happens, 20% times that difference is my expected value of control, and I'm going to give that entire amount to the voting shareholders. So I divide that by just the voting shares. I come up with a value per share of 19.19 reais. The voting shares will trade at a premium of about 1.8 reais more than the non-voting shares. But let's step back. Think about what's driving that premium. If I make this 0.2 into 1, let's say something happens where change is almost imminent. What's going to happen to the voting shares? They're going to pop in value. If I make that likelihood of change 0, let's say the government steps in and says, no way that we will allow change, the two shares will end up trading at the same price. It's extreme because in the real world, often, if you're a non-voting shareholder and something happens, you benefit from that change as well. But in this case, I'm assuming all of the value of change goes to the voting shareholders. That premium reflects it. Sophia?
Basically, those voting shareholders get a free ride on the chance that
That's a good question because, and I'll tell you a story as to why I did what I did. I used to own shares in a Brazilian company called Embev. It was a beverage, it's still around, but at that time it was a standalone Brazilian beverage company. And I owned the non-voting shares, not because I didn't want to own the voting shares, but the only shares you could buy in the company were the preferred shares of the non-voting shares. I bought the shares because I liked the company. And then I read a news story that a Belgian brewer called InBev was buying my company. Is this good news or bad news? As an investor in a company, and you read a news story that somebody's buying your company. Good news or bad news? Good news. I was very excited. They were paying a 30% premium. So I was expecting to see a 30% jump in my price. Fast forward 2 months later, the acquisition gets done. My stock price goes up 3%. You know why? Why? Because in the acquisition, InBev paid for the voting shares. They paid a 70% premium on the voting shares and left me hanging out for the 3% there. I was completely unprotected. And I reminded myself, never again am I going to ignore the power of control when I buy shares in a Brazilian company, because you can see what happens when you don't have the power. What Sophia is pointing out, in some countries, that's called a two-tier offer, where you you target one class of shares, you go after 51% of the class, and you leave the other class completely unprotected. In some countries, there are protections for minority shareholders, which means you can go to a court and say, that's not fair. You can't take all of the premium. You're not going to get the same premium they do, but you can ask for at least a share of the premium. And in some countries, you can't make two-tier offers. You got to make the same offer across the board, and there you're fully protected. There you get the free ride as a non-voting shareholder. So that's why I said this is the most extreme difference. In the real world, the difference is going to be smaller. But the implication still remains, right? If you have a company with voting and non-voting shares and ask you how much of a premium will voting shares trade over non-voting shares, what do you have to do? Value the company twice. If it's a well-managed, well-run company, you're going to find the difference gets smaller. The worst managed and worst run a company is, the difference will get wider. Let's take Facebook. It doesn't have voting and non-voting shares, but its Class A shares have 10 times the voting rights of Class B shares. What percentage of Facebook shares does Mark Zuckerberg own? Does anybody know? 13%. So you're saying, how does he control the company? He has the super voting shares. He controls 57% of voting rights. That's what skews the system. You get 13% of the shares, you got 57% of the voting rights. You know, for the first 6 years of Facebook's existence, people didn't care. You looked at the voting shares and the high voting right, they all traded at roughly the same price. And there are one of two explanations for that. What's the first one? You say there's no chance of control changing. Therefore, what's the point? The second one is companies well managed and one run, what do I care? You know, between 2019 and 2021, that difference between the voting and the non-voting shares at Facebook widened from almost nothing to 20%. What happened? Between 2019 and 2021, what was happening at Facebook? The Cambridge Analytica came out in 2017. That shook it, but people were not. It was the metaverse and Facebook spending tens of billions of dollars without any sense of direction. This was just before Facebook hit absolute rock bottom, where people said, I don't trust the company. So if you track companies like Facebook and Google, you can often track what people think about the management of the company by just looking at that difference between Class A and Class B shares. So you get a chance, look at Google and Facebook, Class A, Class B shares, track it over time. You're getting a sense of how much do I trust the management of the company. If you're voting shares and non-voting shares, doing the expected value control at least gives you a sense of how big that difference should be. One final example. Let's suppose you value a privately owned business, planning to buy the business, and you come up with two values for the business. It's a candy company. The first is a status quo value with the existing management running the business with all their bad habits and good habits built in. You get 1.6 million. Then you revalue the company with what you think would be better management. You come up with 2 million. 1.6 million status quo value, 2 million optimal value. I offer you 49% of this company. What's the most you're willing to pay? What's the critical part of 49%? It's less than 50%. So I keep the remaining 51. So I continue to run the company. And I gave you the status quo value, right? 49%. You're going to cap what you're willing to pay at 49% of 1.6 million. I offer you 51% of the same company. You get to run the company now. And assuming you mean that 2 million is what you think the company could be worth to run better, you're willing to pay up to 51% of 2 million. That 2% difference translates into almost $150,000 in additional amount you're willing to pay. And that's what drives a minority discount. So if you gain the implication, if you have a really well-managed and well-run private company, I'm not going to put much of a discount if you offer me 49%. If it's a badly managed company, I'm going to put a big discount. You know, the Yankees sell small parts of themselves, many sports teams. The Knicks will offer a piece as long as the Dolans run it. I'm going to massively discount that number because it might be the most highly priced franchise in the country, but it's a horrifically badly run franchise, right? That's basically what's showing up when you think about minority discounts. Any of you planning to go into consulting? Sophia, okay. Nobody else is going into consulting? Don't even think about everybody in investment banking pathway? No? Possible consulting? What's the job of a consultant? What do they, I mean, how do you make money as a consultant? Okay, that's, but how do you increase revenues as a consultant? You got to get somebody to pay you money. So why do they pay you money? Why do your clients pay you money? They trust your recommendations. Is that, you think, the key to making money?
Total fairness value opinion for protection for the client.
One second is protection. Third is you don't want to take responsibility for the big decisions. But your job as a consultant is to make yourself indispensable. So your client can't live without you, right? It's not because you're immoral, unethical. That's your job as a consultant. They need you to come back. What's the problem with valuation? At its core, it's simple, right? Revenue growth, margins, reinvestment. If I use traditional valuation, you're probably going to look at it and say, I can do this myself. Why do I need McKinsey to come and tell me what my growth and margins and reinvestment are? I know my business better. So you know what consultants try to do? They try to invent magic bullets that usually acronyms that if you use that acronym, you're going to become more valuable. Let me give you, the essence of what you're trying to do here. You go to management, say, hey, discounted cash flow valuation is hard because you got to forecast the future, which is true, right? Cash flows, revenue growth. So what we'll give you is a metric. A simple metric. If you focus on that metric and increase it, your value will go up. You don't have to forecast. Sounds alluring. The advantage is you now have a simple metric instead of a complex model. But the disadvantage is that simple metric makes assumptions about the rest of the things in your valuation, which might or might not be true. I'll give you an actual example. About the 1990s, the company was founded. It's actually New York-based, called Stern Stewart. It's a consulting firm. And here's what Stern Stewart invented as their magic metric. So as I describe this magic metric, tell me whether you've seen this somewhere before. So they took the return on invested capital for a company. Okay? They compared to the cost of capital and they took the difference. And they multiplied that difference by the amount of capital that the company had. Amazingly original, right? So what's return on capital minus cost of capital? That's our excess return. We've been using it in finance forever. Their innovation was they multiplied by the capital invested to come up with a dollar value. So positive dollar value would basically capture how much additional dollar value you create. And they went to companies and said, you don't need DCFs, you don't need gravity. All you need to do is focus on this EVA. It's what's called EVA, economic value added. And if you can increase that number, you'll make yourself a more valuable company. The problem is, when you talk about increasing the number, they were basing it on 1 year. So basically, they said, what's your return on capital last year? What's your cost of capital? What's the difference? And the larger the EVA, the more valuable you're as a company. And some companies, that's going to be true. But can you think of perverse, and it's a completely perverse exercise, where you can, as a management, increase the EVA for a company while making it a less valuable company? What could you do?
Invest more in the project and develop.
No, wait. Investing more in the project is going to increase capital invested, lower your return invested capital right away, right? Because you'll have a higher denominator. So in fact, you want to go the other way. You want to take investments out of projects or make your capital invested look smaller than it is. And how do you do that? Maybe the accounting is slipping up. Maybe leased assets are not counted. So that's the first thing companies did. They took things and they leased them out because it made their invested capital lower. What else can you do? You can go for high growth in the near term, high return on capital by trading off future growth. So you can say, I want a higher return on capital next year. I get a bonus, but then future growth is destroyed. In fact, you're a technology firm, and I'm not treating R&D as a capital expense. What are you going to do? You're going to cut out the R&D, make your return on capital higher, and then destroy the future of your company. You might even increase the riskiness of your company, which pushes up your cost of capital, which comes with a higher spread. Would you rather earn a 2% excess return on a 5% cost of capital or a 3% excess return on a 10% cost of capital? Think about it. No? What's the present value of this? You take the excess returns, you discount them back to the present, right? A 2% excess return on a 5% cost of capital is worth about 2.5 times more than a 3% excess return on a 10% cost of capital, just a pure math. But if I measure you based on EVA, you're going to focus on increasing the EVA even if it makes me less valuable. There was a point in time in the 1990s when half of the S&P 500 companies were using Stern Stewart as a consultant and building their compensation based on EVA that the company was delivering. It's an extraordinarily dangerous time because you can think of all the perverse things companies could do. Okay. You're saying, why did they need Stern Stewart? Because Stern Stewart said that they were the ones who could compute your return on capital best. They came up with 63 adjustments they made to the return on invested capital, most of which were noise. But this way, you could never compute your own return on capital. You need Stern Stewart to come back every 6 months and say, this is your new return on capital. You've created a continuing business. It's a horrific business model that you've built, but people are making money on it. So that was EVA. Shortcut, a shortcut that sometimes worked, but often led you down the wrong path. The second was an outfit called Holt Associates. It was a Chicago-based consulting firm that came up with a measure called CFROI. CFROI is cash flow, return, and investment. You're saying, how did they come up with it? They took your EBITDA in the most recent year, they did a little dance around it, they adjusted for CapEx, and they divided by the invested capital that year. So it's like a return on capital, but on a cash flow basis. Still based on last year's numbers. They said if you have a high CFROI, you're a good company, a low CFROI is, and again, you can think of scenarios where they work out, but you can also come up with a dozen scenarios where you increase your CFROI and it doesn't work. Deutsche Bank came up with an acronym called CROCI. And I think the acronym should have made them realize this is not going to work. It's tough to go to companies and say, increase your CROCI. But basically, every one of these, you come up with an acronym, you say, this is the shortcut. But the bottom line is, what drives the value of a company? Cash flows, growth, and risk. You can use a shortcut, but if you lose sight of that, I don't care how sophisticated the consulting firm is, you've lost sight of value. The bottom line is there are no new ways to estimate value. Everything that there is to know about value is already known. And all this does is put old wine in a new bottle. So let's return to your projects and look at your pricing. What's the essence of pricing? You try to put a number on your company based on what other people are paying for similar companies. And if you, just to remind you, remember that 4-step process for deconstructing multiples. You start by defining the multiple. You can talk about PE and I can talk about PE and Anna Kournikova can talk about PE, but we could be talking about 3 different versions of the PE ratio. So first make sure you're in agreement on what that multiple actually measures. Remember the 2 tests? The consistency test. Anybody remember what the consistency test is? Can you have a multiple, Ahan? What's in your numerators to match up to what you know? So give me an example of an inconsistent multiple. Price to sales, price to EBITDA, why your numerator is an equity value term. Or you divide enterprise value by net income. I have no idea what that gives you, right? Basically, you're taking a numerator. So that's it. The second is uniform. Make sure it's estimated uniformly because you got to compare it across companies. Easier said than done. You ran into this when you did your peer group pricing. You say, can I use next year's earnings? I said, yes, as long as you do it for all your companies. Can you use 2027 earnings? Absolutely, if you can do it for every one of your companies. You can't selectively do it just for your company. Second stop, play Moneyball. Let the data tell you what's high, what's low, rather than rules of thumb. Is 6 times EBITDA cheap? I have no idea. I have to look at the numbers. That should always be your answer when somebody says 10 times earnings cheap, is a stock trading at less than book value cheap? Look at the numbers. Let them guide you on what's cheap or expensive. Third stop, embedded in every multiple are all of the assumptions you're running away from, right? You know, the ones I'm talking about, cash flows, growth, and risk. The way we arrived at that is you have an equity multiple. I said, go back to the simplest equity valuation model you can use. Dividend discount model. Do the algebra, and you can tell me what drives PE ratios, price to book, any equity multiple. Enterprise value multiple, go back to the simplest enterprise value model you can think of, and it'll give you the drivers of that multiple. And only then do you apply the multiple. Define, describe, analyze, apply. So this is a page, of course, you've seen before. But it basically takes every multiple and looks at what drives that multiple by going back to the core model. The reason I like this page is otherwise you'll have 8 equations that you've written up at different parts of your lecture notes that you're trying to remember, when in fact all you need is one equation and basic algebra. It tells you what questions to ask whenever somebody tries to sell you something based on a multiple. So here's what you used as multiples. But half of you, almost exactly, use EV to sales. Why do you think that is?
Most samples in that because
Your first good reason is you're not going to lose very many companies. I don't think there are too many companies in the sample which have negative revenues or zero revenue, so almost all of them go through. PE ratios, you might lose half the sample. Anything else?
Yeah, so like, you go half of this or you half.
Let's not use that because I've heard that said about EV, but it's really not quite capital structure neutral because your cost to capital can still be affected by it. It's less affected by leverage than a PE ratios. Equity multiples are more affected. Sophia?
Of the sales and liquidity, and that's just the most familiar. What's happening.
That and the fact that many of you valued money losing companies or companies where last year's earnings were not capturing what the company could make in the long term, right? EV to sales, EV to EBITDA, work with companies that are money losing and companies on the verge of making money much better than other multiples. That's not always been the case. When I first started teaching class, half of the class used PE ratios or price to book. You almost see that same shift happening in the market away from equity multiples to enterprise value multiples. Here's what you found with your pricing. If you remember with the DCF, you found the typical company to be overvalued, right? With your pricing, your typical company came out as underpriced. The median price, so if you look at the price as a percent of, how can that be? How could you find that your companies were undervalued and find them to be overpriced? Yeah.
markets will very different from fundamentals. So you can look at, I mean, I think the market regressions are the best where a sector wasn't well represented, so it looks like it's super, super expensive.
Every pricing is a conditional statement, right? What's a conditional statement? Given this stuff I'm comparing my company to, my company looks cheap or expensive. Your pricing answers a very different question than your intrinsic valuation. In your case, you're getting a split. In fact, I'm surprised that number is not closer to 100%. You know why, right? If you do pricing right, it's relative. You should be converging on roughly half of all stocks being underpriced. You have a little more tilt towards underpricing than overpricing. And if I'm sorry, that's actually a DCF as a percent of pricing. I should. So your DCFs were lower than your pricing for the most part. And if you look at all pricing, you pretty much got a 5% overpricing. So, let me take that back. Your pricing too, you found overpricing, but not by as much as you did with the valuation. So here are your most underpriced companies. Okay. So the way to read this is the price as a percentage of your pricing. So Spirit Aviation Holdings, I have no idea, your price was only 10% of your pricing. Pricing was a much higher number. Those are your most underpriced stocks. There's some familiar names. Palantir came out as one of the most underpriced, but before you get too excited, Palantir also showed up as one of the most overpriced. See, how can you explain the same company showing up in both the underpriced and the overpriced list? What do you think accounts for that difference? Lisa? Different peer groups, right? Remember, that was a choice many of you struggle with. Should I compare to what companies am I comparing with? And you can see very quickly the pluses and minuses of pricing. Pricing gives you something closer to what the market's at, but depending on what you're comparing a company to, the same company can look at like it's underpriced, overpriced. In fact, the Nissan thing, as I said, I'm not sure what to make of that. Right? So, let it kind of hang out there. Right? A few of you were able to use option pricing. What are the two requirements for your company to be a candidate for option pricing? What were the, Claire? Money losing and? Try again. Money losing and lots of debt, right? It's a debt that makes you, because the option for pricing is a option to liquidate. And the strike price becomes the amount of debt you owe. So there were relatively few, a lot of you did money losing companies, but most of them were money losing growth companies. Option pricing doesn't work there. It's money losing companies with a lot of debt, big airlines losing money. Boeing, you could argue there's optionality. There were 36 companies where you were able to use, out of the 325, about 10%, where you were able to use an option pricing model. In those companies, the option pricing model gave you a value about 31% higher than what you got with a traditional intrinsic valuation. Where's that extra 31% coming from? It's coming from that optionality, that you bought, it's an out of the money option right now, but to the extent that the option becomes in the money, it could be valuable. Right. So the last week, I fielded a lot of emails from you. It gotten to the last stage, and you got a price, you had a value, a DCF value, and a pricing, and you said, I am not clear what I should do now. And I'll put you in, there were three camps you fell into. One is, I've done the work, but I'm not sure yet. You know what? You will never be sure. It's going to be it's a psychological thing. You got to get over it. The second is, you did the valuation, you've lost faith in the fact that you can actually pick stocks, which is perfectly okay. Become a believer in efficient markets after you value the company. And the third is that if you value a company and you get ready to buy it and you feel really scared. I told you, I bought BYD. I'm hoping to buy Palantir. The reason I was able to pull the trigger is, for me, BYD is not going to be my entire portfolio. So I feel okay doing it because I don't have to be right on every investment. I just have to be right on average. And this is a problem, right? Because when you first start investing, you don't have the law of large numbers working in your favor. You're buying one stock. So how do you get over that? I mean, it seems like a vicious cycle, right? You need to have enough stocks to be able to make that jump, and you can't get to enough stocks if you never make that first jump. Is there some way in which people can get started in investing where they can make that jump? Start with something that gives you a base. It could be an index fund. I know it feels like you're giving up, right? You're saying, I spent 4 years at NYU. I spent an unholy amount of money getting that degree. I should be picking stocks. Let that go. Buy an index fund, get started. Buy your first company. It's going to make it easier for you to do it. Buy your second company, and by the time you get to the fifth or sixth, you can start reducing your index fund holdings if you feel you're being successful with your choices. And over time, you can end up. With my kids, I've actually gone in the opposite direction because I've been the portfolio manager forever now. Don't ask me how that happened. They were all grown up. I'm still their portfolio manager, but I've started to move because for the bulk of their investing, I used to buy the same stocks I bought for myself. But in the last decade, I've actually moved them out of individual stocks into index funds because I don't want them to have to do the maintenance work. You know what I mean by maintenance work, right? Because once you value a company and you bring it in, it's not one and done. You got to go back and revisit the company. It's not fair for me to ask them to keep track of what BYD is doing every year for the next 10 years. They have lives to live. So there I'm moving them in the opposite direction, and it's painful. You know why it's painful? Because getting them out of individual companies that have done well means that they have to pay taxes. They complain like it's no end in sight. They say, you made me pay taxes. They say, be glad you have to pay taxes. I could have given you a lot of losses if you'd wanted, but I'm picked, So it's something to think about, that balance between individual stocks and having an anchor on your portfolio. So let's get to the bottom line. This is what your recommendations look like. I think you had 105 buys and about 160 sells. 32% buys, 56% sells, 12% holds. One of these days, I'm going to teach a class where nobody holds. I used to call it chicken to try to force people out of hold. Sometimes you just can't make that final decision. You think that's unusual that buys are less than sells?
I think so. Just because it's easier to put a buy on something, it's easier to tell a really great story than it is to tell a terrible story.
Really? I would think there will be people who disagree with you. It depends on your personality. Some people have the Eeyore personality, right? If you stick with the Winnie the Pooh. But I don't think if Eeyore valued companies, he'd ever find an undervalued company. Right? Eeyore is going to be a terrible venture capitalist. Right? Tigger might be a much better VC, right? Because he's going to bounce around and say, one of these days, you know. In fact, this percentage is varied over time. This is the history of buy and sell recommendations going back to 1999. I'd love to tell you it's a leading indicator what the market's going to do. It's nothing of the sort. It reflects the mood of the moment, what the market is doing, and you can see the number go up and down. So focus on this black line. That's a buys divided by sells, and you can see it's higher than one, lower than one. We're in a particularly depressed quarter in terms of buys. And I'm not surprised because you've been surrounded by bad news. It's kind of tough to break through and say, I'm going to buy in the face of this much macroeconomic uncertainty. Finally, I mean, that's, you know, when you did your pricing and you did your DCF, some of you got different outcomes, right? One said to buy, the other said to sell. And you say, which one do I pick? And you wanted me to pick for you, and I refused. I kept pushing it back on you because there is no right answer. Because it depends on two things. One is, what are you trying to put a number on? The kind of asset. How marketable is it? How much, cash flows does it generate? And luckily, nobody picked, Bitcoin to value for this class. But if you did, you can't value it. There are no cash flows. You can only price it. Against what? Against fiat currencies, against other paper currencies. But to the extent that you're valuing something that has cash flows, you have the choice of doing intrinsic valuation. But which one's right for you will depend on what your time horizon is. I know that Brian was at the Berkshire Hathaway meetings. Who else was at the meeting? Somebody else, right? Two people went to the Berkshire Hathaway meetings. It's going to be historic, maybe last meeting that Warren Buffett is on the stage. And, I mean, I think nobody would contest the notion there was one of the great investors of the 20th century. Okay? And one of the things he had going for him was the fact that he controlled his time horizon because he was investing insurance company money. We talked about this earlier. Insurance money doesn't panic. You can invest in the face of the worst crisis and get away with it. If you have a long time horizon, it's not always something you get to pick. Clearly, you're more likely to do intrinsic valuation than pricing. It depends on why you're doing the valuation. Many of you are going to end up in jobs, so your job is a pricing job. Do the pricing. If you want to do reverse engineer and do a DCF to make it look like you did an intrinsic valuation, by all means do it. You now have the tools for hiding your biases, right? You know where to put it so nobody will find it. That's perfectly okay too. And finally, you got to create, this is a process. Start thinking about where markets make mistakes, how they correct their mistakes, because that's how you create an investment philosophy that's right for you. I mean, one of the things I admire about Warren Buffett is you're clear about where he's coming from. He's authentic, right? I mean, he's basically preached the same message now for 50 years. It's not like he, it's not like he's shifting his views based on what's happening. Because he has a clearly thought out view on where he thinks markets make mistakes. You might not like it, but it is where and it gives him that core from which he builds an investment. That's what you're aspiring to, a way of thinking about markets that's uniquely yours based on what you see out there. This is a question I asked at the start of the class. I might as well revisit the question. Remember early in the class, I think session 2, I said, at that time you hadn't done an intrinsic value, you hadn't done a pricing, so it was like picking between, I don't know what it is. Now you've done an intrinsic valuation of pricing. I'm going to ask you the question again. You don't have to tell me, but answer it for yourselves. You started with a point of view about one being better than the other. Has that point of view changed? Any believers in intrinsic valuation are now much more pricers than they used to be? Sophia, what is it that made you change your mind?
How much in the DCF is my own judgment? Before I saw DCF as something that's, like sensitive, and then I saw how much my own judgment goes in there. And now I feel like the change, increase in objectivity, the increase in trueness that DCF gives compared to relative valuation might be not worth the effort.
Yep.
That CF
And I think that's legitimate, right? Did everybody get Sophia's point? Because before you do DCF, you think it's a set of rules and models and metrics. You follow the rules, you're going to get but the reality is you have to make big assumptions, and you look at those assumptions and say, what if I'm wrong? Which is what drives you to pricing. Are there people who start with pricing, go to intrinsic? Absolutely. There are people who go the other direction. And a lot of people do both. And you know what their conclusion is? This is way more difficult than I thought it was. Markets are not as stupid as I thought they were. You know what? It might not be a bad idea for me to buy index funds and going back to living the rest of my life because I don't think I can find systematic undervaluation markets. All three are fine as long as you get to it on your own. Earlier on, I also asked you whether you're more naturally a storyteller or a number cruncher. And I want to revisit that classification. If you were a storyteller when you start the class, I pray that this class has given you enough comfort with the numbers that if somebody says return on invested capital, you don't run for the exit, you know exactly what they're talking about. You're not intimidated by it. That you get enough comfort with the numbers that you're willing to use the numbers as part of your story, and that you use the numbers to actually discipline yourself when you tell a story. That you're not carried away into fairy tales. If a banker tries to intimidate you by using 8 times EBITDA, you shouldn't be intimidated anymore. There's nothing there. Yesterday, I picked up this 2-page document. I think you might have seen a club is created for as a guide for people doing interviews with investment banks. Typical. You've seen that where they list typical interview. Yeah. One of these days, I'm going to do a webcast when a banker asks you a question about bank, where you can ask the banker back the question to see if the banker actually understands EV/EBITDA. Not, so save it because don't actually do it in an interview. You'll kind of ruin the interview, but have it ready to go. Because let's face it, most of your interviewers have a surface level understanding. And if you dug a little deeper, you can very quickly start to these things come apart. Right. If you're a number cruncher, here's what I hope you got out of the class. I hope, and this is a much tougher challenge, I hope you have enough faith in your own imagination that you're willing to be wrong, that you're willing to make that jump even though there's nothing to back you up. And it makes us uncomfortable. It's psychological. Some of us will never get to that point. But if you can make it, as a number cruncher, you'll be a much better. So it's that combination. Work on your weak side. That's basically what I'm saying is whatever your weak side is, that's what you need to work on. So let's wrap up. Every time I hear somebody say the fundamentals don't matter anymore, I'm reminded that the fundamentals always matter. Now, in the 40 years I've been teaching, people say, oh, it doesn't matter whether the company makes money. .com boom, now I hear it in AI. Let's face it, the truth is ultimately everything still comes back to the same things that it's always driven value. Second, focus on the big picture. There are times when we get easy to get distracted in valuation. I don't know how much time you spend on the cost of debt for your company. But if you spend a lot of time, you probably spent it in the wrong place. Why? Because most of your companies have debt ratios of 5%, 10%, 15%. What difference does it make whether they have a AAA rating or a BBB rating or a CCC rating? Ultimately, your cost of capital is driven by what happens to your cost of equity. Third, you will run into people who tell you, I've been doing this 40 years, trust me. Don't trust them. This is one business where experience doesn't give you wisdom. And the fact that you've been through 3 market crises doesn't make you any better dealing with the next one, which is a good thing. The person next to you has 40 years of experience, barely knows more about markets than you do, because they often fall back on things from the past that don't hold up. Fourth, and this is the point I made about the valuation, the scarcest resource I see in investing in valuation is imagination, being creative, being willing to be wrong. Which brings me to my 2 final points. Spend a lot of time talking about valuation, right? Don't take any of this stuff too seriously. Remind yourself it's only a valuation. If your reaction is what else is there in life, you might seriously be in need of spiritual counseling. Talk to your rabbi, your priest, I still remember about 15 years ago, end of one of my MBA evaluation classes, second year MBA comes up to me. She was a history major from Yale who came back for an MBA. And usually if you're a history major from Yale who comes back for an MBA, you take what used to be the strategic MBA route. Today it might be the sustainable MBA route. You know what that is? Pick every class with the word strategic or sustainable in it. And you can spend 2 years, never see a number, and get an MBA. She ended up, I think, by accident in my class, which is not a strategic or a sustainable valuation class. And she was actually pretty good at it. She came to me at the end of the semester and said, I never thought this would happen, but I have a job as a sell-side equity research analyst.
I said, my condolences. I said, no, no, congratulations. Okay. And she said, I'm really scared. I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. Brain surgeon makes a mistake, somebody dies on the table. You make a mistake, what's the worst that's going to happen? Somebody gets a little richer. Somebody else gets a little poorer. Just make sure that somebody else who's getting a little poorer is not you. That's your only constraint. Think like a Marxist. You move some wealth around. Nothing in valuation is worth losing sleep over. So if you're lying awake at night, say, what tax rate should I use in valuation? Just let it go. Finally, if you're ever given a choice between understanding everything there is to understand about valuation and being lucky,
Which one should you pick? Be lucky. Brought home to me by my mother-in-law when she came to visit in early 2000. My mother-in-law became an avid investor in the 1990s, which to me should have been a sign that the market was topping off. This is actually a classic sell indicator. Mother-in-law, big investor, get out of the market now. But I kind of missed that sign. So all day long, all she would talk about what was in her portfolio, what was out of her portfolio, what she wished was in her portfolio. And I'd listen because that's what son-in-laws do. And she let it slip that she owned a company called Qualcomm, which was one of the great stocks of 1999, up 600%. So I asked her, Judy, why do you pick Qualcomm? I know the minute I asked this question, I shouldn't have because she told me. She said she picked Qualcomm because it owned MCI. I said, that's not Qualcomm, that's WorldCom. She says, Qualcomm, WorldCom, what's the difference? I said, you bought the wrong company. If you really meant to buy the company or an MCI, you'd have lost 30%. Instead, you bought some company that rhymed with it and you made 600%. She wasn't the least bit phased. She owns Cisco. I was afraid to ask her why she owns Cisco. I'm afraid the answer might be I like Saturday Night Live, which is disco, or vegetable oil, which is Crisco. But who knows what drove that decision. But after she left, I did try a strategy. I'd pick a company, pick one that rhymes with it, buy it. If I'd made a lot of money, this entire class would have been rhyming stocks and see which one made more money. But if I have a parting thought for you, be lucky. And reminder again, your final exam is a week from today. And I think I've made my thoughts clear about I prefer people taking it online, and I did give exit patches for those people who cannot do it. But I will see you next Monday at, 4 o'clock, right? 4 to 5:45 next Monday. One final question. Ahan asked me whether I'm going to do in-person office hours. I'm actually leaving for San Diego tomorrow morning because my daughter's having a cesarean tomorrow afternoon. So I will be there for the next week. So I'll try to do it from there, but I'll be back again for the final exam.
Really last minute. Thank you.